Good morning, everyone. My name is Gao Zhe, and today I will be presenting an overview of how macroeconomic insights can guide strategic decision-making in the business and financial sectors. Understanding the broader economic environment is fundamental for anticipating market trends, managing risk, and identifying growth opportunities. In this presentation, I will explore the key stages of the business cycle, access current macroeconomic conditions, and explain how fiscal and trade policies influence market dynamics. Finally, I will connect these macro-level insights to behavioral economics and demonstrate how they can be integrated into form strategic and operational decisions. The business cycle describes the fluctuations in aggregate economic activity over time, primarily measured by real GDP, inflation, and unemployment. As outlined by Monkey, the cycle typically moves through four distinct phases: expansion, peak, contraction, and recovery. During expansion, economic output rises, unemployment declines, and confidence strengthens. Peak represents the high point of activity before growth slows. Contraction follows, marked by reduced spending, investment, and employment. Finally, recovery brings renewed demand and rising production. Understanding where an economy stands within this cycle is critical for strategic funding, pricing, and trading decisions. For example, during expansions, firms may adopt a more aggressive growth strategy, while in contractions, capital preservation becomes a priority. In 2025, global and regional indicators suggest that Singapore's economy is experiencing slowing but positive growth, moderate inflation, and stable employment. According to the World Bank 2024, Singapore's GDP growth is expected to stabilize around 2.5%, supported by resilient domestic demand and strong fiscal buffers. At the same time, the monetary tightening cycle appears to be approaching its conclusion. Central banks in advance the economies has paused the rate hikes, signaling a potential shift toward policy normalization. For financial institutions and investors, this represents an ideal window for portfolio repositioning, balancing between defensive exits accumulate during contraction and new growth opportunities that arise in recovery phases. The phases of business cycle directly shapes market liquidity, client risk appetite, and product demand. In periods of expansion, liquidity improves as investment flows increase. Clients seek higher returns and demonstrate greater risk tolerance. Conversely, during contractions, risk aversion rises, reducing demand for speculative products and shifting focus toward safe exits. As noted by Berger et al. 2024, understanding liquidity creation and its macroeconomic drivers is crucial for banks to align capital allocation and credit strategies with prevailing economic conditions. Therefore, macroeconomic monitoring is not only an academic exercise but practical necessity for guiding operation decisions, pricing strategies, and resource deployment. A major component of Singapore's 2025 fiscal policy is the tax rebate program, designed to stimulate domestic demand amid slowing external trade. According to the World Bank 2024, this fiscal boost effectively shifts the aggregate demand AD curve to the right, leading to short-term increases in output and mid-inflationary pressure. In the short run, the policy is expected to enhance household consumption and business investment. However, as Monkey 2021 explains, long-run benefits depend on sustained consumer confidence and productivity gains. If these factors persist, the temporary boost could translate into an upward shift in long-run aggregate supply, LRAS, supporting potential GDP growth. For financial institutions, physical expansion presents both opportunities and risks. Increased household liquidity boosts the demand for financial products such as FX, credit, and investment instruments. Firms can capture this momentum by proactively positioning currency and credit offering before demand peaks. At the same time, banks should prepare to support client hedging strategies, as higher spending and borrowing could introduce new exposure to interest rate or exchange rate volatility. As emphasized by Willamutu and Harman in 2022, align liquidity management with physical circles enhance both profitability and resilience. Proactive engagement in this phase allows institutions to expand market share while maintaining regulatory compliance under framework like Basel III. Trade policy remains another crucial macroeconomic factor influencing global markets. The imposition of tariffs generally raises domestic prices and reduces trade volumes. According to the standard economic theory, tariffs benefit domestic producers and government revenues but harm customers, exporters, and global investors through higher prices and reduced efficiency. In Singapore's context, rising protectionism among major economies such as the United States and China has created uncertainty for the exporters and the logistics firms. As highlighted by Saunders and Shell 2024, disruption to global supply chains can tighten liquidity conditions and heighten volatility in both currency and commodity markets. Businesses and financial intermediaries must develop adaptive strategies to mitigate the impact of trade disruptions. Tariffs and geopolitical risks tend to increase fixed and commodity price volatility, while declining trade volumes can worsen bid ask spreads, reducing liquidity in affected markets. However, this environment also creates new opportunities by expanding risk advisory service and developing hedging instruments tailored to trade-exposed clients. Institutions can transform volatility into value creation. As Eraso mentioned and as 2021 notes, regulatory interventions such as vintage sandboxes can support the rapid development of new financial products that respond to evolving market risks. Beyond macro indicators, understanding behavioral economics is key to interpreting real-world decision-making. Traditional models assume rationality in practice. Clients often display loss aversion, angering, and overconfidence. According to Tyler and Stenson 2021, loss aversion leads investors to avoid necessary risks or exit positions too early, while anchoring causes resistance to new pricing information. Recognizing these biases allows financial investors and managers to anticipate irrational behaviors and design communication in strategies that improve decision quality. In other words, market behavior cannot be fully understood through data alone. It requires insight into human psychology. We can leverage psychology to guide better outcomes. Reforming decisions in terms of potential missed gains reduces fear-driven exit. Presenting pricing context differently helps clients accept necessary rent adjustments. Internally recognizing base enhances tender discipline and governance. For example, presenting forecasts as probability distributions rather than point estimates can help reduce overconfidence. As Tyler and Sunstein 2021 emphasize, choice architecture allows organizations to design better decision environments that guide rational outcomes without restricting freedom of choice. To integrate macroeconomic understanding into strategic management, firms must synthesize data from three primary domains: economic indicators, policy trends, and behavioral insights. Economic data inform risk and pricing strategies, policy analysis guides market positioning, and behavioral understanding enhance execution and client engagement. According to the Bagel et al. 2024, firms that combine quantitative macro analysis with behavioral awareness achieve superior liquidity management and client retention. This integration transforms abstract economic knowledge into actionable strategic advantage. In summary, macroeconomics isn't distinct from our business. It's the foundation of it. Fiscal and trade dynamics created new risks, but also new opportunities. So we combine macro foresight with a behavioral understanding. We make smarter, faster, and more human decisions, securing our leadership in global market. Finally, let me show my reference list. All resources follow MIT Harvard referencing style.